Who called the bottom? I called the bottom. Who called the rally? I called the rally. Boom. Welcome back to the Nobel Show. It's Josh here, and we're going to do another market recap. What happened today? What's going on? What should you be paying attention to? Let's hop right into it. Well, I was going to use this screen as a little cheat sheet, but now my face is lit up like I'm a dead salesman, so maybe we're going off the memory from the top. So Peloton is the first deck I want to talk about. Now, several months ago, I was kind of talking about this because it was part of the conversation, and we're kind of seeing it play out now. Now, what that was that these companies have such massive demand that they can't keep up with. The fear would be that they build up too much supply and the demand falls off. We're seeing that play out already with Peloton. Now, Peloton in particular, I feel like has shown to have weak management, and that weak management is definitely continuing their bad streak of poor decision making, especially when it came to the way that they handled that insider report that came out, which was saying that they were going to halt all production and fire a bunch of employees. Now, the CEO then came out and he was like, well, actually, I haven't made a decision on it yet, so... and then people were like, yay. I don't get the yay there. It still seems extremely bearish to me. He didn't say any of it was wrong. He just said he hadn't decided yet. So, and then the company rallied on NFT news because they're going to start making NFTs, which I also see as bearish because to me it's like, okay, now they're doing a money grab because they can't generate profits elsewhere, and they're going to cut a bunch of employees. And production slowing down. Yes, they do make money off of renewing subscription for the workout stuff and everything, but right now I think it's a terrible time to buy the company. But it does bring another conversation into the light, which is like Apple would love to buy Peloton, or our Netflix, who we saw is really maturing as a company, having trouble driving growth, having trouble, beating these earnings, and then starting to raise prices and stuff. What this company really needs to do is to build on their IP and get more content when it comes to gaming or streaming or podcasts. They really need to start branching out. Buying out Spotify would be awesome. Now, what's the issue right now with buyouts is new regulation is currently playing out when it comes to buyouts. And big tech is under a microscope. So if you're buying up these stocks in anticipation that, you're hoping for a buyout, I would really pull back on that. I've already pulled back on some of my favorite buyouts that I thought would have potential. One of those being Sonos, who's a stock I've owned for a hot minute, which is they make speakers. They make great home speakers. They've been a leader in that sector for a minute. They did great during COVID. Since then, the stock's been really poor. But I've pulled back out of that. I've kind of pulled more out of docs. I'm worried about potential buyouts. Now, Microsoft was able to get an acquisition on Activision, but that's because Microsoft's been very under the radar. Pretty much because having a monopoly on corporate software is not a headline grabber, so they don't get as much attention. They kind of get this, just what am I trying to say? They just get to glide through without anyone giving them scrutiny. Now, and that also could probably be lobbyists, but we're not going to get stuck in that conversation. Let's bring it back to these buyouts. I would take a step back before you think that you could get some big buyouts on these stocks, or you think that there's some opportunities here, because I do not anticipate these companies to make a big move and go through all the process of a buyout just to have the politicians say, oh, we changed the rules. That's not a good idea. The risk reward is not there. They're not going to put the time into that with all these considerations at play. Now, if they do, I would assume it would go through, because there must be some sort, if there is a rumor of it and we see some moves, I would assume that's going through. Some lobbyist is, rubbing the right balls. I don't know if I should say that, but I did. So, activating my spooky ghost because I forgot what I was going to talk about next. Meta created a new supercomputer. It's very cool. That should help them with their new developments. They're trying to create cool stuff in the metaverse. Whether they're going to stay dominant in this sector, it's really too early to say. I know there was lots of fears and headlines like Meta was going to turn it into a monopoly. Decentralization solves this with time. I have no concerns about this. The supercomputer is cool, but until that actually reaches the public sector and everyone has one, it's not really has big implications. applications. It'll just help them with design and also make everything in design have to be scaled down so that people can actually utilize whatever it is they create. It's a nice innovation though, and it does have some implications, especially when it comes to people building quantum computers. Remember when this new tech comes out, it's not linear, it's exponential. So these things will get better and get better at getting better, if that makes sense. So that about it covers it for company news. So let's go ahead and blast off, take a 50,000 foot view, and kind of look forward at what I'm anticipating for the market. I recently commented on some Twitter posts. Some people are arguing whether they're bullish or bearish. I think all this stuff is stupid. I hate labels, whether they're political, whether they're sentimental. It's just all stupid to me. One thing matters: making money. If you're not a perma bull that sometimes has bearish sentiment, then you're just wrong. Markets go up over time. That's just the reality of what it is. Having any sort of discussion, it's a waste of everyone's time. Okay, so let's really break down what's going on. Yes, we saw the rally. As I said in the Discord, for all the Discord members, I did anticipate this rally. I called the bottom out on Twitter, and now I'm expecting more downside on the way. Now, when that downside hits, we don't know. If we look at the Elliott waves, which are never a perfect technical analysis because we're seeing lots of chop as it plays out. Remember, when you're in a bearish market, it doesn't go just straight down. When you're in a bullish market, it doesn't just go straight up. Well, I mean, when there's massive stimulus, it does, but typically you won't see that. These are very obvious things. I think it's time, I've been talking about supply chains and some of the complexities that exist there, but let's remember when it comes to the macroeconomics, there's only 4, 5, 6 data points we're following. This doesn't have to be as complex as everyone's making it seem to be. When it comes to the global politics and how that's playing out, yes, it's complex. But when it comes to the domestic issues that is going on, let's not overcomplicate this, all right? Remember that buying the dip will come eventually. There'll be a point in time where this will be a great opportunity. And what I don't want to do is trade heavy into a Fed rate decision when it appears that no matter what decision they'll make, it could cause lots of market volatility. The only positive I see for what the Fed could do is maybe if they just take their hands off the wheel and say, whoa, we want to see inflation play out. Now, we need to talk about China. I'm going to do that in a separate video. So we're just going to talk about the domestic markets today, okay? Or at least for this video. I think later tonight I'll have a few more. I've been working on some. Hopefully we'll have some visuals. Yay. So when it comes to what the Fed's doing, right? GDP's been lowered. So, it makes it really hard to justify interest rates, especially since what the Fed's usually looking at is that GDP and then employment numbers. Both of those are not looking too hot. If you stack on hiking interest rates, especially if you're aggressive about it, you're going to send us spiraling into another bear market and more lows. Now, if you do the opposite, you're like, whoa, it looks like the market needs support. It looks like the economy needs support. We're having this big drawdown. You can't go that route either because inflation's so high. These prices are so high. You can't justify printing money, even though we're seeing signs of this actually being more transitory than expected. You still can't do anything. And I highly doubt the Fed is really going to take their hands off the wheel when the big political conversation is about inflation and rising prices. The Fed is likely going to trail the reality of what we need to actually do. But they have all this political pull, and these politics are going to play a huge role into what they do. It's very rare that we see the Fed take a U-turn on what they're doing. You remember when these Fed reports come out, when the minutes come out, they only change a few lines, month over month. So when we're looking at that, it's going to be very rare that we see them make a dramatic turn. Now, granted, they could surprise markets. But right now, what I'm thinking is I'm seeing bearish on the technicals, bearish with the Elliott waves. I do see a little bit more upside, but looking past that, I see new lows on the way. And so I'm accumulating my money. I pulled some of my hedges and my puts out right now, and I'm going ahead and I'm accumulating cash, and I'm getting ready to see how these new trends play out. Where is that wave going to start coming back down? And if you look here, keep in mind that the market is signaling that there won't be a fourth interest rate hike right now. We're starting to see that also pull back. So this short-term downturn, the new lows I'm expecting, just remember that this means that we could have a great end to this year still. So when I said don't get all panicked yet, that's what I'm talking about. In the future, this could play out just fine. We could see a normalization of GDP, and then the Fed quits hiking interest rates. And when that normalization kicks in, we could see markets return to a normal uptrend. This volatility that we're seeing, a lot of this will play out. Hopefully nothing happens, in the global markets, and we'll return to some normalization. So that about covers it for today's episode. Hope you found it helpful, and I'll see you in the next one.